If you had invested right before every crisis. Every major market crisis begins the same way. Confidence cracks. Headlines turn alarming. Experts argue about how bad things might get. And investors everywhere feel the same knot in their stomach. This time feels different. This time feels worse. This time feels like the moment you should step back and wait. But almost no one ever asks a quieter, more uncomfortable question. What actually happens if you invest right before a crisis, and then do nothing? To understand why this question matters, you have to understand how people experience crises in real time. When markets are rising, investing feels easy. Risk feels distant. Optimism feels justified. But when markets fall sharply, the emotional experience changes completely. Losses feel personal. Uncertainty feels endless. And fear feels rational. That emotional shift is what drives most investing decisions during crises, not data, not history, and not long-term thinking. Let's go back to the dot-com era. In the late 1990s, optimism around technology was extreme. New companies were launching daily. Valuations made little sense in hindsight, but at the time they felt justified by the promise of the internet. When the bubble burst, markets didn't just fall, they collapsed. Many investors who had entered near the peak saw their portfolios cut in half or worse. For years afterward, markets struggled. Confidence was broken. Commentators declared that stocks were no longer reliable for building wealth. Now imagine investing right before that crash. The early experience would have been brutal. Losses would have appeared quickly. Patience would have been tested. It would have felt like proof that investing was a mistake. And yet, over time, the market recovered. New leaders emerged. Entire industries were built. Investors who stayed invested long enough eventually saw growth resume. Not immediately. Not comfortably. But eventually. The same pattern played out during the global financial crisis. In 2008, fear wasn't limited to stock prices. It was about the stability of the entire financial system. Banks failed. Credit froze. Governments intervened. People questioned whether markets themselves were broken. If you had invested right before that crisis, you would have experienced one of the sharpest declines in modern history. Selling would have felt like the responsible choice. Yet those who stayed invested through that period were rewarded in the years that followed. The recovery was not smooth, but it was powerful. Entire portfolios rebuilt and surpassed previous highs. Again, not because investors timed anything well, but because they remained invested long enough for growth to reassert itself. Then came COVID. In early 2020, markets fell faster than at almost any point in history. Fear spread globally. Entire economies shut down. Predictions ranged from prolonged depression to permanent damage. Many investors sold quickly, convinced the worst was yet to come. What followed surprised almost everyone. Markets rebounded with speed few had anticipated. Investors who exited during the panic often missed the recovery entirely. These examples share a common thread. In each case, investing right before a crisis felt like the worst possible timing decision. In each case, staying invested felt uncomfortable, irrational, and emotionally exhausting. And in each case, long-term outcomes were far better than short-term fear suggested. This is where time becomes the most misunderstood variable in investing. People talk about long-term investing as if it simply means waiting. But waiting through volatility is not passive. It is psychologically demanding. It requires resisting the urge to act when action feels urgent. It requires tolerating uncertainty without reassurance. And it requires accepting that clarity only arrives after the opportunity has passed. Another element that often goes unnoticed is reinvestment. During downturns, dividends continue to be paid. When reinvested, those dividends buy more shares at lower prices. Over time, this accelerates recovery and compounds returns quietly. It's not dramatic. It doesn't make headlines. But it plays a meaningful role in long-term outcomes. There is also the issue of missed days. Research consistently shows that missing just a handful of the market's best days can significantly reduce long-term returns. What makes this particularly challenging is that many of those best days occur shortly after the worst days, precisely when fear is highest and many investors are on the sidelines. Crises never feel temporary when you are living through them. Each one comes with convincing reasons why recovery will be slow, incomplete, or impossible. Each one feels unique. And yet, over decades, markets have repeatedly adapted, restructured, and grown. Not because crises are harmless, but because economic systems evolve. This does not mean markets only go up. It does not mean every investment succeeds. And it does not mean losses don't matter emotionally. They do. But history suggests that the greatest damage to long-term outcomes usually comes not from experiencing a crisis, but from abandoning the market during one. What's rarely discussed is the cost of waiting. Investors who sit in cash waiting for certainty often miss periods of recovery that restore confidence and momentum. Inflation quietly erodes purchasing power. Opportunities pass unnoticed because they don't arrive with clarity or comfort. The idea of the perfect time to invest is seductive, but largely fictional. The moments that feel safest often occur after prices have already risen. The moments that feel most dangerous often precede long-term opportunity. This inversion is what makes investing emotionally difficult. Investing before a crisis is not a strategy anyone actively seeks. But understanding what historically happened when people did, and then stayed invested, offers perspective. It reframes crises not as endpoints, but as transitions. Painful transitions, but transitions nonetheless. The real risk is not experiencing volatility. Volatility is visible, immediate, and uncomfortable. The real risk is allowing fear to permanently sideline you from growth. Over time, that decision compounds quietly in the wrong direction. So when people ask whether it's possible to invest at the wrong time, the more important question may be whether it's possible to wait forever for the right one. History suggests that waiting for comfort often comes at a higher cost than enduring discomfort. If you had invested right before every major crisis and stayed invested long enough, the experience would have tested you emotionally, but the long-term outcome would not have been failure. It would have been participation in recovery, growth, and compounding over time. Which do you think is harder? Investing when markets are crashing, or staying invested when nothing feels certain? Let me know what you think in the comments. Like and subscribe for more.